Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, January 3rd, 2021. First trading day of the year, and I'm going to go over the updates on various trade ideas in this order. We're going to start with the U.S. equity markets, major ones, S&P 500, Nasdaq 100, and Russell 2000. I'll do just a quick overview there, nothing in depth, and then hit on some of the. I want to go over some of the ag commodities that I've highlighted recently as trade ideas. That includes wheat, corn, and coffee. Then we'll hit lumber, do a quick update there, Treasury bonds, and then last I'm going to do the precious metals, only because I got an update out to you this morning showing you my thoughts there. So not much to add, but I'll just going to recap that. And that whole thing, if I go through in the order I think I will, or the time I think I will, should be 30 minutes or less. All right, ES, starting out here on the equity markets, the S&P 500. Most recently, we put in this divergent high right here. We made a slightly higher, rough, almost equal, but again, marginally higher high with continued divergence, especially on the PPO. We've been building divergence now all the way from back here. So this is our divergence extended. We're a little bit off the high, not much. And you have a big level here. That's why I have that line colored in yellow that I think will trigger more downside if we break that level. So if you're bullish, you can buy pullbacks to that level. Again, my trading style, when you have negative divergence on a breakout to new high, I'd prefer to wait to see a failure there and then add to any short positions, because that would prove to be a false breakout. Again, if we solidly break back down below that level, and that's 47.31. Roughly, and again, that's these highs here. We had a high there, tested it again, tested it a third time, rejected each of those 3 times. You can see that, and then finally broke above it. But this happened right at the end of the year, as I said. Very little, if anything, means or the moves, I should say, mean very little, if anything, to me when they occur during that uber low holiday trading volume. Not only that, you have quarter end, year end, all that position squaring. So like I said, I take everything that happens technically, whether it's bullish or bearish, with a grain of salt on the last week of the year. So everyone's back onto the field now. All the players are on the field, or will be getting back into gear this week if they're not in the market today. And that's it. So we're looking at a divergent high here. Wash, rinse, repeat stuff. That was our last divergent high there. We had one there. Both of those again highlighted. Even this one was a divergent high right there. So odds favor a break back below that level, but we could do that and then burn through the divergences. That would be your bullish case. So those are levels to watch either way. And if we break it, where do we go? At least down here, I think, to 46.13. If it's anything other than just a little whipsaw down through there, and then possibly, or quite likely, come into this uptrend line as well. They come in together right there. So 46.13 and the extended uptrend line, that would be, again, a minimum target, and that's about a 3.5% drop. But as I've gone over before, the charts are pricing and the potential for a whole lot more. I'm going to kind of segue into that when I get into Treasury bonds and tell you, go over something there regarding the yield curve. Next up, NQ Nasdaq 100, still off its highs from back there in mid-November. Right there, you can see we came a little shy of it. So the sell signals that we had back here and here in November, early and mid-November, are still very much in play. In fact, we're trading right now a little bit below that second sell signal and a hair above that first sell signal. So again, it depends your trading style. There are plenty of opportunities to cover and reverse long at these divergent lows. Right there, you had divergent low 1, divergent low 2, each led to a rally, and then of course to get back short off these divergent highs. But that's where we're at. So let's not make read too much into it. If you want to look at it this way, I box it in here. That's a big trading range we've been in now for several months, right? And downside break, which I still favor, should take us down here to my if things get ugly target. I believe that's coming. Again, I'll talk a little bit about it fundamentally, at least what Treasury bonds are telling us, or could be telling us here soon. And when I get to those later in the video here. So that's it. Levels to watch. Well, the big one, it's kind of been traded through a little bit recently, but not too much. Right here, that line I should have colored yellow. I didn't do that, meaning it's just a little more significant than the others. That's 16,420. We're going to call it 16,425. Round off, it's closest to 16,424. Why to have that line there? That was an all-time high right there. Again, tested, broke out, and that was a failed breakout. Once we failed, we had multiple attempts to break through that level. Each of those rejected, resulting in a correction. Rallied back, rejected, rejected, rejected again multiple times, sent down again. And so that put in, if I have two yellow lines here, meaning very significant, it's right here. And it does the same thing I just gave you on ES. It boxes in that trading range and says bullish if we break above it. Now, if you want to really have a line that should be there as well, it would be that recent high, because of course traders always look at breakouts to all-time highs, and remember this one fell a little bit shy, but that lower line is at 15,536. So even just to get us back down there again would entail a drop from where we're at right now at about a little better, 5.25% from where we're at right now to get down there. And near term, I don't want to force these lines, but maybe a little price channel right here that could cause a near-term rally if taken out. Otherwise, that's a downtrend line. Maybe active traders could game this channel, meaning go short at the top, close your longs, and or cover shorts or go long at the bottom, as long as that channel stays intact right there. I really don't expect fireworks today. Maybe this week, we'll see. We are now in 2022. I think there was a lot of window dressing into the end of the year. Mutual funds want to show they were long and bullish the equity markets because they had a good year. So they have that on their books the last day of the year, Friday the 31st. But now we know we're going into 22, and about the only thing we know for certain, nobody knows, your guess is as good as mine, what's going to happen in the markets. But we do know with almost certainty that the Fed's going to raise rates. They've already made that pretty clear. We're looking at 3 hikes this year. And, the bulls have had one argument to hold, that they could have solid footing on for the last several years. Don't fight the Fed, easy money, rates going down, or at least holding at the floor is what they've done more so. Once they hit zero, there was nowhere else to go but up. And now we know they're going to go up. So based on, that one simple variable, you would think that that's going to be a headwind for stocks. Now, how much they go up? Again, one thing I guarantee about the Fed, I've always said this, they are reactive, not proactive. I take what they say with a giant grain of salt because the Fed is always behind the curve. So what I should predict they're going to have to, maybe it'll only be 3 hikes this year, but it'll probably be one of those might be a half-point hike or something like that. They might try to throw a little bit in there, or they'll talk it up too, because this is not yesteryear's Fed. The Fed of yesteryear would do intermeeting rate cuts and intermeeting rate hikes, things like that. And now, for whatever reason, this Fed believes that they have to be uber transparent, because the minute they move against what the market expects, the market throws a hissy fit. We saw it in the fourth quarter of 2018. We've seen it many times in the last 10 years or so. And so Powell's Fed is a Fed of trying to telegraph their moves so far in advance. And of course, we know that he's been backpedaling, but very slowly backpedaling to go more hawkish from where he was very dovish, 6 months ago. Okay, that's all fundamental stuff. So we'll see what happens there. Most important is price action. The markets have shrugged off COVID recently. They shrugged off a lot of things. So, the economy's strong. Give it that. I'd say that. Economy, at least down here in this neck of the woods, businesses are booming. But that's also, how markets typically top. And just remember, it's always darkest before dawn. Think back to March of 2009 when it looked like the world was going to end because the markets had already fallen 55% with seemingly no end in sight. But of course, then the bottom comes, and the same thing on the top. Markets always top when things are as rosy as can be, because stocks look out 6 to 9 months ahead. So again, let's play it day by day, minute by minute, and right now I'm just trying to tell you that's a level to watch. We're flirting with it right there. If we fall much below it, then this whole thing right here, let me just circle it for you, show you what I see. That's not the tool I want. Let me box it in. This breakout here, just like this one, will prove to be a false breakout. So to me, this is still a significant level, 16,423, 425. Why did it happen again? Well, again, that's the week of Christmas, and whipsaws are more than common. But we're right back there. We're not below it enough to say it's a failed breakout yet, but if we start to move lower, I think it'll become apparent to the masses that this breakout, just like that one, failed. And look, we already hit the bottom of this trading range twice, that 15,536 support. It was also price targets when I had it back here after the sell signals. So we already hit that level a couple times. If we run down to it again, my money's on a break below it. But again, first things first, we need to start moving down lower, and then I can say with a little more conviction that this breakout right here, this recent breakout, has failed. Okay, hopefully that makes sense to you. That's short-term stuff. I'm going to show you the small caps, and then I'm going to talk just a second about the divergence between the Nasdaq 100 and the equal weighted Nasdaq 100 index. So before we do that, let's look at RTY. RTY, this is a 120-minute chart, meaning every candlestick's 2 hours, goes back 6 months, and pretty much this is the low right here, because you can see this major reaction low there. We almost hit it there, and another low there. This was also a divergent low, which was bullish, positive divergence, and it was a catalyst for this rally so far. But today we hit, just like last week, 2278 is a level to me. I see a reaction high there. Popped it briefly, but then failed it. Popped it or failed it there. Popped it briefly, got above it, but then we failed it here and had a sharp move down. And then, more importantly, some recent distinct reactions on there, including, oops, something it just disappeared on me. RTY, where did you go? I think I hit the escape key and pulled up another chart. Bear with me as I find RTY. Okay, so here's where we're at today. We have a small divergent high. Need to see it reverse here. We're at resistance 2278, so I can make a case for an objective short there. Bulls want to see it break out, and if so, my next resistance is at 2337 right there. But based on these divergences and everything else, I think we'll probably get rejected here, move on down. If so, these divergences should be confirmed soon, and then you want to watch for another run at the recent lows. Let me just put a line down there below that, give you a price level from that reaction low back here in mid-July. That's about 2090. And remember, if you look at, I've covered this many times before, if you look at the daily chart of IWM, this is what it looks like. You have just a massive, very clear and fairly tightly compressed trading range right here. There was a failed breakout above it. We shot back down. Once the breakout failed, we went right back to the bottom of the range, which is at about 208.50 right there. Right? So bulls want to see a solid breakout to the upside. Bears want to see a breakout to the downside. And if so, I still maintain that target of a 170. It'd be a pretty big drop in the small caps. Now let me loop back over to another chart here and show you this one, QQQ in black right here, the Qs. And you have in blue, well, let me give you a different color tool here. There it is, QQQ in black, this black line, and this is QQQE, the equal weighted Nasdaq 100. And what you'll notice, what I always notice is, and I've talked about this breadth deterioration, it can manifest or show itself in many different forms. I've showed you percentage of stocks trading above their 50, 200-day moving averages, the number of advancing versus declining stocks. There's many breadth indicators. This is one probably less common used by most traders, but I like to look at it. And again, it's showing you the QQQs, which are one of everyone's favorite indexes because it has a very high weighting in the mega. The highest growth, fastest growth companies, the biggest companies in the world: Apple, Microsoft, Alphabet, Amazon, Tesla, Facebook, the big fangs. And as such, they've been, doing most of the heavy lifting. Now, at times, they really start to outpace the equal-weighted Nasdaq 100. And when you get that gap, notice this big gap right here, when it really starts to separate, that's when corrections usually happen. And then here, I'll show you, because you can see if I zoom in like this, because over time you're going to see outperformance in the Qs over the QQQE. But it's these little spikes where what it is again, those handful of very heavy top weighted index stocks are doing most of the heavy lifting. And I've covered this many times recently. For months now, the majority of the stocks in the Nasdaq 100 actually been going down. And why isn't the index going down? Because it's that very heavy weighting given to those top components, and it's just not a healthy sign. They're doing well, whereas the majority of stocks aren't. There's another big gap right there, followed by a correction, gap followed by correction, a little bit of a gap there, followed by correction. But this right now, this disparity is big. I'm going to roll back to, let's say, this low here in early October. And in a normal market, everything should be moving up and down roughly in sync. Doesn't have to be perfect. But since this point in time right here, you can see this is mid-November. Here's my scaling down here, November 1st. There's the 15th, mid-month. So this is when QQQ topped right back here around the, I don't know, 20th or so, give or take a few days, right? And so did the Nasdaq 100 equal weighted index. Well, QQQ, I told you, it didn't quite make it to that high yet. Almost. It's right off that high, not far. And look where the equal weighted. It went from here way down. This is showing you huge disparity. And again, there are no guarantees, but it just is a sign that things aren't well under the hood, because most of the stocks are falling and not keeping up. And this lift back to almost to the old highs, it has been almost single-handedly helped by just a handful of companies, the ones with the heaviest weighting, that have skewed that index higher, when in reality you're seeing a lot of the companies fall. Okay, next up, quick update on some of the ag commodities. I mentioned wheat is a short trade recently. Wheat had put in this big divergent high recently right here. I'm talking negative divergence. This is the daily chart of WEAT. That's the wheat ETN, tracks wheat futures. Had a secondary or minor uptrend line right there with a primary trend line right there. So it's dropped, broke down, made a perfect back test. Honestly, I can't remember where I last updated this one. It may have been on that back test, it may have been on the breakdown, but either way, this one's playing out and appears to be headed down towards that target of $7 and the intersecting uptrend line. So looks good. Still gives us another, we're getting close. Remember, it's a ag. This is wheat. It's not Bitcoin. It's not a high flying tech stock or IPO. So you're not going to make 50, 80% on the swing trades. You can get on the trend trades if you're willing to sit tight, off the bottom. I've been bullish on this one for a while, including right here. Last long entry, or for a swing trade or trend trade, up 71%. But again, right now I'm looking, I think these ag commodities, there's some steam I know there's some steam coming out of them, and I think a little bit of more steam. Everybody knows the Fed's starting to tighten, tap on the brakes here with both their rhetoric and soon to be their actions. Well, actually no, currently, because they're already reducing their bond buying program, so they're tapering off that. So we're going to see rate hikes coming, and again, they're trying to quell or slow down this inflation trade that they were completely wrong on. Calling inflation transitory, and then realizing, oh, okay, maybe it's not so transitory. So that's why rates are going up. So there it is, a little more downside in wheat. I like to trade the futures, and so to give you a quick update there, ZW, got it here somewhere. Let's cue that chart up. Bear with me. There it is, ZW. Alrighty, so on the 60-minute chart, 120-minute, sometimes I loop over to these 120-minute charts, just gives you a bigger picture. We had a longer-term uptrend line there that was taken out briefly. Divergent high right here, negative divergence, right? So this is swing trading. Off that divergent high, we correct it. Right here, we put in positive or bullish divergence. And we had a rally, broke above the trend line. But most recently, we put in a little small divergent high here, and again, I'm looking for more downside on that daily chart, and this divergent high is playing out. So far so good. Wheat's down another 1.3 or down 1.3% today. Next target on the futures is still here. It's 733.295. We'll call that 733.300. and then possibly down here. But keep an eye on that wheat daily chart I just showed you, WEAT, because as I've said quite often, it can be the case of the tail wagging the dog. Back in the day, there were no ETNs. If you wanted to trade commodities, this is what you did. You traded futures. And then, in recent years, with the advent of proliferation of ETFs and ETNs, you have a ETN that'll track just about anything now, or an ETF. And so what I'm getting at is sometimes money flows into those. I know for a fact, gold, I've read up on this, and, a lot of big hedge funds, multi-billion-dollar hedge funds will buy GLD, the ETF, instead of physical gold or gold futures. And so therefore, inflows and outflows of ETFs will affect the price of the futures. I'm not sure what, how widely held WAT is, but sometimes those things do have an impact. As such, where am I going with that? Again, you'll want to watch key support levels on both of them, because a lot of times the buyers will step in on, let's say, WAT at support, and you might not see maybe the futures, let's say at the time, are right below my 733 300 level, but then WEAT hits that daily uptrend line, and that's where the buyers step in. So I like to watch both, even if I'm only trading one. Next up is corn. On a related note, tends to move together quite often, and that's ZC are your futures. Most recently, nice little divergent high right there, negative divergence, and then we told you we needed to take out both this uptrend line right here and that 597 300-ish level, because that was our previous. There was a major high there. We tried it again, failure. Boom, breakout, right? Bullish, right? Nope, wrong. That's a failed breakout. Looks bullish. It's called a bull trap. Bulls go in, they buy the new highs. Shorts get squeezed out, but they weren't paying attention to the divergence and what's going on in the daily chart. So as of now, that breakout failed, and it failed pretty impulsively. Nice move down today, earlier, or maybe that was yesterday's last candle. But you can see we're solidly back below there. So the bottom line is we failed the breakout so far. It's not a super well-defined level, but decent. There are some support levels on the way down, such as the one we're trading at now at about 588. You can see that. Next level here, 581, about 581.57 or so. We'll call it 581.5, 571.5 right there. But I think we can work our way down here to 553 in wheat. Let me pull the daily chart on that. Okay, there's wheat, backtest breakdown, primary trend line there, and I think I showed you corn, but let me just make sure. So that's wheat, divergent high on the daily, breakdown backtest of the minor trend line. Yeah, I think I already showed you that one, and then corn. And there's corn. So corn had this divergent high recently right there with this little bearish rising wedge, which we're just cracking below. Targets 2064, and then I think ultimately come down here to at least that 1917 level. And that would put us in a trading range, a lot like the stock market's been in recently right there. If we break the bottom of that level around 19 change, then it'd probably take us down to 1744. That would be my worst case scenario right now. I'm still longer term bullish on ag commodities. So right now, let me clear that line out. What I favor is this, something along these lines. But we'll see when we get there. Let's see how the charts look. Maybe that happens. Maybe something different. Maybe we never even get there. So again, I'll continue to do updates. And another one that I highlighted recently was coffee, KC. And this is also a 120-minute chart. We have now taken out that primary uptrend line on the 120-minute chart, 6 months price history. There's our divergent high recently. We had a little minor trend line break there that sent us down to this level, set up with the secondary trend line, which we broke down in back test. We were dancing on the primary trend line for the last week and so, and finally broke it today. So there's a sell signal, but to really get some traction, we're going to have to take out this level. I think we'll move down there. That's about 218 on coffee futures, KC. Gotta keep an eye. There's some positive divergence, potential divergence there. It could result in a bounce off that level, but I think for now, I'm still leaning towards another leg down in coffee. And let me show you how it looks on the ETN, and that is JO, like a cup of Joe. We have this uptrend line here on the daily chart, which we're just cracking below right now, but again, there's some price support just below. So coffee could have another run up here, But again, I'm seeing an exit, and I think it's going to gain momentum. A lot of these Johnny-come-lately people and funds, hedge funds, and professionals or retail traders have probably jumped in commodities. Didn't want to buy them back here because commodities were still, by most accounts, in a bear market. But they start getting fear of missing out and reading about how inflation's running away. So I think you got a lot of those people that need to be checked. You need to clear out those weak-handed longs, and so a little correction there would do a nice job for longer term, setting up the stage for the next leg up. But again, support is support until unless broken. That bottom of the support is about 58.80 or so right there. And then targets, I got to give you another one here. These are old lines down here. Ignore all those other support levels. Certainly right there, about 54.93. Definitely a target if that level's broken. And let's just, for now, let's leave it there. That's be my worst case scenario if we get a really ugly correction, a drop all the way back to about the 46.80, 47 level. Again, if we get there, I'll address it at the time. But as of now, let's just say this is a near-term target. But you got to break that support zone that we're on right now. Next up, lumber futures, and I do not have an ETN or ETF equivalent for you because, to the best of my knowledge, one does not exist. If you want to trade lumber futures, you got to trade the lumber futures contract. That's LB, random length lumber futures. This is a daily chart. Pretty simple strategy is just look for these high-level bearish PPO crossovers. Here's your PPO. If you don't have a PPO in your charting program, you could try a MACD. It's a very close cousin, but I like the PPO. There's a bearish crossover. We had one right there, and it was good for a drop. I'm going to measure the high that came right after. It's not right on there, so this isn't what you would have gotten had you just gone short the crossover. But it was a decent drop associated with that crossover, about 17% there. And obviously this one a whole lot more from top to bottom. That was about 70%. Off that drop. So you get the picture. Lumber, I always say lumber is a trendy little sucker. It's like natural gas. Natural gas actually has been consolidating lately. I'm going to skip it in this video. I can't get that line right now. But anywho, this is just your wash, rinse, repeat. These are swing trade opportunities, corrections, and I'm sure you could do the same thing with bullish cross. Not so sure, but I like divergences, and there was positive divergence at that low, and lumber was mentioned as a long back then. But most recently, okay, this was our last bearish, high-level bearish PPO crossover, right here. Oh, gosh, I'm making a mess of this, guys. Look like a kindergartner doing finger painting. All right, bearish PPO crossover, high level. There's and the last one there. This is going back a whole year. So you would have, you'd be batting 1,000 if you just shorted it at that time and just put a stop, above your entry and let it run, and we had one there. Now this one, we're back to we went slightly underwater, and I talked about that. You got to give a trade like this room because lumber in a single day, this thing can go up and down, 10%. It's volatile like natural gas. But there it is. We had an uptrend line, which was recently broken. That's where I highlighted as a short. We got a sell signal. We had a little snapback rally. Sometimes it's one and done when you break a trend line like this and you never look back, just like, right here, for example. But sometimes you have a snapback rally. You make a marginal new high, and in doing so, which we did here, we put in a divergent high. So if I liked it on that first breakdown, you got to like it better on the second breakdown. Before the holidays, I mentioned this minor secondary uptrend line, which would need to break, and we got a break and a close below it last week, I think on Friday. So sell signal triggered. But I'm going to zoom in now to a 60-minute chart and show you what needs to happen. Nope, that's not 60-minute. This is a 60-minute chart. Here's what needs to happen for this trade to play out and get some traction and get a solid trend reversal. Right now, it's kind of up near those recent highs. So there's that first trend line I showed you when there was sell signal number 1 right here, right, on the breakdown. Then we put in the marginal new high, which was also divergent high. Remember, that showed well on the daily chart. You can see negative divergence here on the 60-minute chart. Then, as I said, you need to take out the secondary trend line, which we did, but the selling is not impulsive. So what I've done since last week is I've added one more level here, and that's that previous high right here. You can see all those reactions. and then we have reactions from above, and we're dancing on it right now. So if you zoom in real tight, you can see that in the video, I believe. Why did it do that? I hate that. Here we go. Yep, nope. Got to get, there it is. We're back to that chart. These charts are a little sensitive. If I click the wrong spot, another chart comes up. There it is. So you can see I have that aligned. That line's at about horizontal support about 1128, give or take. And you can see all the reactions on there so far. It was resistance. We popped it, right? And now we're back testing, back testing. If we can clearly get down below that level, and based on the technicals, I think we will, then we should start to see a new trend. And remember, lumber, it can consolidate, but for the most part, as I showed you here, lumber is either going up or it's going down. There's almost no in-between button on it. There's an uptrend. You get counter-trend rallies here and there, but there's a downtrend. There's an uptrend. There's a downtrend. There's an uptrend. You don't see a lot of this sideways back and forth stuff, at least not in recent years. So swinging it down to, I think, let me give you a level right here on the daily chart. At least I think we'll come back to about right here, and that's about 860-ish right there. Of course, you have a reaction low right there that's likely to come into play as well. If you want to take quick profits, it's about 980, and then that target there. And maybe we'll come in and hit this potential uptrend line right here. If you want to just let it go and let it ride for a longer drop, there's a potential uptrend line off the lows back from about August right there. And then you have a couple more reactions there in November. Next up, Treasury bonds. Okay, so I gave you my thoughts last week. A couple weeks back, I was bearish up here. We were hitting resistance on longer-term resistance on TLT. I'll get to that chart in a minute, the 30-year long bond ETF. And we also have resistance here on the futures. And then we put in a divergent high, negative divergence, and we corrected. And then I told you last week, probably best to just cover that position because we're at support on TLT. I didn't have much of a thought on it near term. But now I'll tell you, I looked at the 5-year, I looked at the 10-year, and this is the 30-year. I couldn't make a screaming case to be long those other than the 5. I'm going to get to the 5-year in just a second, but TLT I think may bounce. So here's what's going to happen, I think. Looking at the charts and also fundamentally, it's almost a near certainty we're going to see short-term rates go up. Remember, the Fed they directly control the shortest end of the yield curve. They control the federal funds rate, and that is the shortest term rate. It's technically overnight rate banks lend to each other, can borrow from the Fed. That's the or borrow from each other, and then there's the discount window. I think that's when they go directly to the Fed. But same thing. Those are just very ultra short-term rates. And the market more controls the longer-term rates, market participants, including the 30-year bond. Fed can certainly influence. Believe me, they have a lot of money. They've been doing their quantitative easing and bond buybacks. And however, the markets are going to determine ultimately where the 30-year goes. And the 30-year now, if you want to say, hey, things have been booming for a while, COVID hit the Fed and Washington, by my accounts, and I think others overstimulated the markets. They did too much. The pandemic, it's a real thing, but it also, it shut things down for a while only because they mandated shutdowns everywhere and everybody panicked. But I think we all agree they overstimulated the market. And if you want to argue that, then why is inflation at 40-year highs? So it's obvious, and again, everything's humming along. However, nothing lasts forever. So if as 2022 starts to progress and you start to see the short end of the yield curve go up, because that's what's going to happen when the Fed raises rates, if the market participants believe that long-term growth expectations and inflation expectations, either or, are going to drop, then Treasury bonds should rally because their long-term rates should go down. Remember, when interest rates go up, the price of a bond goes down and vice versa. So if rates are going to go down on the long end of the yield curve, you'll see market participants start to step in and buy. Either way, I wanted to say I think this is a short-term trading op in ZB. I don't have the highest convictions, but there was enough that I took a fraction, well, one contract right before the video in ZB. We'll see if it bounces. I can always add to it. There's some minor support here. It's not great, but I see enough reactions right there, and it's certainly oversold here on the 60-minute chart. Here's your RSI right here. You know, usually when it gets down to this level where we're at right now, you can see we got there right there, right? What happened? Did you want to be long or short there? Long. We tapped it again there, and then we put in positive divergence after hitting it there. So we came in just slightly higher, and there was that was actually lasting bottom until oh, not the right tool. We use that just that line tool all the way up here, right? Then we put in a divergent high. So you get it. Anyways, even down here, we had almost hit that line, and we had a nice tradable bounce. And then again, we're at that line now with a positive divergence in place. Potential divergence. We need to bounce soon to get these to put in lower lows here, or higher lows I should say, on the indicators. So either way, you want to take a shot at it, I would use a stop maybe right below that previous reaction low, or even a tighter stop in there somewhere, and go for a bounce trade. Or, you know, if it starts to pan out, what I like to do sometimes, and I'll probably do with this one, is let it ride. Just have your stop in place. If it starts to move up here, raise your stop to entry, so no matter what, you're not going to lose anything in case it drops down. And then if it continues to pan out, periodically raise your stop. Let me show you the chart of TLT, and part of my reasoning for taking a shot. So the other day, or going back a few weeks ago, I told you we had this trading range here, and there was an objective short at the top of the range. We popped the top of that range for a single day, got rejected hard the next day, and so that trade planned out. We got a nice short trade there, and after getting rejected at the top, we fell to the bottom of the range, and we hit this trend line. That's where I said last week, you know, probably good idea to cover, because we're at trendline support with the price support just below. Now we're at the price support level, which is about 146. You can see that we're a hair below it, not too much, and there's a couple reaction lows below there. Those are those same reaction lows I just showed you on ZB, where you might want to stop between. So based on that, PPO is coming back to the zero line. That sometimes acts as support, so we could bounce there. And again, this would be if market participants, as we're heading into the new year, believe that that the rising rates that we're going to be seeing on the short end are going to lead to slower growth expectations, because then you'll see yields drop, which means bonds go up. And you may also see if the markets start to correct, or we see softness in equities, you can get that flight to safety bid into treasuries. So again, I can't make a screaming buy on it, but I think it's worth a shot. And especially I like being diversified. I have, you know, many different positions, different asset classes at any given time. So there it is. Oh, and on the 5-year FVX, remember we're just looking at the bond prices right here on TLT. If you want to look at the yield of the 30-year bond, you go to TYX, and so that's it. So remember, TYX is also at resistance. See this line right here? That's 2010, or 2.101%. There is we're right there. We're right at resistance. We got rejected there. We got rejected again right there. It was support once we broke it there, and it was resistance, 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 support, resistance. So there it is. So there's the case to take a shot at a short. So yields come down, and then when we look at the 5-year FVX, remember, you're getting closer to the that shorter end of the yield curve there, and the 5-year looks like it's ready to break out. It's been moving up. We all know rate hikes are coming. And this is, you know, we knew it. A lot of us did before Powell knew it, because Powell was, again, being dismissive on the risk of inflation, and so in recent months he started to pull a 180 and recognize that it's not really transitory like he thought it'd be. And so therefore he's got to raise rates to slow things down. So you can see this was a big level back here, about 12.97, almost, you know, 1.3% on the 5-year. And you can see it was key support right there, right? We hit it a few times, and once that level went, it was lights out for the 5-year. And of course, that's a lot of the Fed taking rates down to the ground when COVID hit. So again, fundamentals and technicals do go hand in hand. But we're back to that level, and say what you want about it, but I think it's a key technical level. So maybe we pull back, maybe not. If we do, 9.2 is support right there. But a breakout above that level is going to be bullish. And so now to bring this all home, so basically that is my expectation, that ultimately we're going to see this 5-year breakout, rates going up, and I think the 30-year may drop. So that segues into this chart. This is or these are a couple charts of the yield curve. The yield curve, they just take the differential between, in this case, you can do it different ways. This is a historical chart of the 10-year to 1-year spread. So you take 10-year Treasury bonds and the difference between 10-year and the 1-year. And you can see, I'm going to have to zoom in for you. I know we're on in video mode here. Okay, here we go. Nice and tight. All right, 10-year. Oh, no, I went zoomed. Okay, I'll get back to that 1 year. I'm sorry. We had to move the window around and zoom in and all out. But again, this is pretty good stuff here. An inverted yield curve has predicted the past 7 recessions. 0 failure rates. This line right here, 0%, the 0% is when the yield curve inverts. Meaning that short-term rates go higher than long-term rates, which is an unusual phenomenon. And in every instance, without fail, going back the past 7 recessions, see these shaded areas, these shaded gray boxes? Those are recessions. See this little one? That one was over before we knew it, because that was massive intervention. The Fed staved off what was written into the charts even before COVID hit, that a recession was coming. They're natural phenomenons in the business cycle. You get them every so often. They're absolutely needed. I've given you my analogy of the forestry company here, forestry service here in Florida, where I'm from, and they do it out west. They burn down the undergrowth on fire. They're called prescribed burns, and they keep the underbrush burned down because if they don't, it grows out of control, and then a lightning strike or an errant campfire or something like that is going to just burn down everything, including the 100-year-old trees and everything around it. And so, and recessions work that way. You've got to let the weaker businesses get flushed out, so those that survive and can then flourish. But when you keep everybody afloat, like the government's done, it is not good for the longer term outlook for the economy. Anywho, that's that. Say what you want about it. That's the fundamentals. That's the way it works. But I wanted to point out the yield curve in the 2 to 10, every time it's inverted, keep in mind it's not a timing indicator. It was years before the recession actually hit. Remember, the recession, at least by the technical definition, 2 quarters of contracting growth or GDP, it can take years. And so it hit, and then we had another inversion there. Then the recession came a couple years later. Here was our inversion. It took a while for the recession to officially be, registered. Again, we inverted right here. Took a little while. We inverted back here. Took a couple years there as well. That was the big bear market, or they called it the Great Recession. The market dropped from October 2007 into March 2009. There's your recession. And again, it came ahead. Now there was our signal. The 2 year just kissed. It didn't really cross. It kissed that line, and again, everything was staved off. But what I wanted to point out here, okay, so you can pull this up. You can just Google search yield curve. Once it inverts or comes close to inverting, then that's it. And usually, then you have strong economic growth. The curve starts normalizing even before the recession's over, and that's it. And you don't look back, right? Well, what's happened this time? Remember, there was massive intervention. They prevented a recession that should have happened, and by all accounts probably still will. And you can see we're already starting to fall. Let me go back to that 1 to 10 year spread right here. There it is, and I'm going to slide over here. And so you can see the same thing. This one did invert. See, there's our inversion that we had. And there was a recession that followed, but it's so small you probably can hardly see it in the video. There's a skinny line here. That's about as short as it is the shortest recession we ever had, at least going back into the 70s. These were bigger. And so I just wanted to point out, there's our inversion. There's our inversion. We tap the line there. There's our inversion. There's our inversion. And again, usually after the inversion, the recession comes, everything's purged out, and things are good. And then it leads to firm footing in the economy, and the yields go back up. The curve goes back to normal. A normal yield curve looks like this. It's upward sloping, short end, long end. But here we're already starting to fall. So that's my expectation, guys. I know I spent a little more time on this than you probably wanted to hear, but I think we're going to see, I know we're going to see short-term rates tick up. This Fed will not, again, they have to telegraph everything so far in advance that I don't think Powell's going to back off his hikes. The market will have to, if the market throws a big enough hissy fit, he'll probably drag his feet and all that. But we're going to see some hikes this year, I think, undoubtedly. And you can see right here, when you look to the left, here's the yield curves right here. This is a cool chart as well. Current in blue. So here's the current yield curve. See, here's what's going to happen. Remember, this is a normal sloping yield curve. This was just over a year ago. In December of 2020, this was our yield curve right here. And that's a normal, fairly normal yield curve. That's what it looked like in December 2019. It was flat, but it was still upward sloping. Now, we're all but guaranteed to see this. Remember, rates have been at zero because Powell pulled them down there when COVID hit. It was a little bit above there in 2020, and he took them to zero, and he's held them there. That's what the Fed controls right here. We know the Fed's already going to do, what the talks are, I believe the dot plot is 3 hikes. That's going to take us up to 0.75%, be right here. So you're going to see this blue line come up here. And see how the long bonds are starting to fall? That's going to be, and I believe what we'll see is an inversion of the yield curve. You're going to see the short end moving up, the longer end moving down, and if that continues, ultimately we could see an inversion there, and that again, it's got a pretty darn good track record of predicting recession. So something to watch right now. We are not going to invert today, tomorrow, or next week, not even close. Again, it's just a trend to watch, and if that trend starts to materialize that way, you'll start to hear gradual rumblings about it in the financial media, and the stock market will probably start to reflect it. So that's kind of longer term stuff, guys, not timely trading. I think you can maybe go for a bounce trade in TLT right now. Keep your stops tight, don't fall in love with it, or ZB, and then this is longer term stuff to watch for in 2020. Alright, I promised you an update on the metals, but I also told you the video wouldn't go this long, so I'm going to make it very quick. I gave you this morning just kind of a scale-in zone. You can see these recent lows. Yeah, we just put in a divergent high, and yes, that's usually bearish and has been. But again, where I think we're going, and a lot of this has, I'm not going to get into a lot of detail now, has to do with the euro and the US dollar. I think this is an overreaction in the, not an overreaction, it's certainly technically induced. I'm talking gold. This is gold, 120-minute chart. We put in a divergent high. So this little correction here is certainly warranted based on the technicals, but we have good support here. I think the buyers are going to step in there down to my support zone. So I think it's an objective time to buy. I think, in fact, once they realize this divergent high didn't play out for this or this like it did before, I think you're going to have a lot of people that shorted this or longs that got out that are going to want back in. So that's my scenario on gold. Hey, if you're a longer term swing trader, you can let it come all the way down here. We still have very good support about 1751, 1763. I'm still more partial to silver than gold. I have them both, but favor silver a little bit better. And 22,619 is good support, and I'd be buying this pullback, and I did. I added to it. There's a divergent high right there that was a catalyst for it, but I think we'll head on up there to that next target of 2380. And I'm fine if silver wants to come on down here to 2231. Won't be so happy about it if it goes below there, but look, there's really good support about 2148. And then last but not least, I've already gone long enough in this video, I might as well show you gold. Remember, gold, bigger picture. I believe this to be bear market consolidation. When you look at a weekly chart, you have this nice big triangle pattern right here. Here's a weekly chart of gold. See this triangle pattern? Triangle patterns are inherently, they're consolidation patterns. They can go either way, and usually they go the way of the trend. And here's a bullish trend right here. This is a solid bull market in gold. Nothing goes up forever. It got, there was a bottom back in late 2015. It's been moving up since. So a breakout above here, I think, will be the catalyst for the leg to new highs in gold. Now, a breakdown below there is not going to be good for gold. I'll say that now. However, we still have, I know this is a busy chart, my buy zone I've laid out for you guys for, gosh, over a year now, even since we topped, and I thought it was time to get out of the long-term positions in gold and or go short for a correction. Well, we hit my buy zone several times and we're still above the top of the buy zone right now. And there's that triangle here. I even have it on another board on the daily chart. This is what it looks like. So you can see gold, there's our uptrend line. Still in an uptrend, still in a bull market. It's been consolidating. Need to pop that level. Not going to be good if we go much below there. But so we'll play it by ear. And I'll continue to do updates as I see objective entries or objective exits if you're an active trader. And let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.